Hey everyone, welcome to my channel. I'm Doris and I'm here to talk about the upcoming many expected US recession. Big layoffs in the tech sector are not a sign of downturn in the United States economy. In a report in November 2022, analysts at Goldman Sachs, a prominent investment bank, made the forecast. But just a month later, Goldman Sachs embarked on the biggest layoff in history. People are very nervous and anxious. Everyone is waiting for the results, a Goldman insider told the media. In mid-December, Wall Street financial giant Goldman Sachs Group plans to cut 4,000 jobs worldwide in January 2023, about 8% of its workforce, while the bonus pool will be cut at least 40%. Investment banking sector is the hardest hit area. It was founded in 1869 as the world's largest financial institution. Goldman's survival of the fittest has almost years, but this time, the layoffs on a record. It is not without warning. We'll have a bumpy future and we'll have to be more cautious about financial resources, especially in the short term. In 2022, Goldman CEO David Solomon said publicly several times that he wants to control spending in the future. Initial warning came from July, when Solomon saw dismal second quarter results and judged that the U.S. financial market could remain depressed for a long time. Goldman could slow hiring and cut expenses in the future. In September, Goldman Sachs cut 500 people, which had been suspended for 2 years, in the work period, and those who kept their jobs will find that their year-end bonus will be much less than expected. During the COVID-19 pandemic, the U.S. Treasury and the Federal Reserve adopted a crazy rescue plan in 2022, injecting about $5 trillion into the financial market. In March of that year, the Fed urgently cut interest rates by 150 points, keeping the federal base rate near zero. In 2021, the Biden administration continued to increase its effort, approving another $1.9 trillion in the U.S. rescue plan. A flood of flooding and zero interest rate easing surged in financial transactions and stimulated Wall Street into a boom. Goldman Sachs benefited greatly, with net income of $59.3 billion and net profit of $21.6 billion in fiscal 2021, up 137.25% year-on-year, and a record high. At the time, Wall Street investment banks, led by Goldman Sachs, also saw a hiring boom in response to the growing business volume. Under David Solomon's leadership, Goldman had 49,100 employees by the third quarter of 2022, a 34% jump from 2018. Goldman Sachs' work environment has always been very comfortable. During the 2021 boom, its executives will receive 8-figure bonuses, and regular employees will include free coffee, free lunch, and free commuter services. Entering 2022, however, Goldman Sachs has suddenly had a rough time. I think we're going to be worse than other Wall Street companies, said a senior Goldman employee. He believes Goldman's layoffs are also likely to be the fiercest of the biggest lines on Wall Street. Excessive expansion in the previous 2 years has led Goldman to see a 33% increase in spending on compensation and benefits alone in 2021. Can reduce expenditure. Open source is also a problem. In the first half of 2022, the IPO financing slowed sharply, shrinking Goldman's business volume. The number of transactions fell by 73%, and the amount of transactions fell by 95%. Goldman Sachs' second quarter 2022 results show that its net profit fell nearly 48% due to the 41% drop in investment banking revenue. The headwinds brought Goldman's earnings in the first 3 quarters of 2022 up between -40% and -50%. On Goldman's future, CEO David Solomon said in an interview that it'll depend on where the Fed moves and inflation as follows. It's not just Goldman Sachs. The same thing is happening across Wall Street. During the boom, 5 largest U.S. investment banks, including J.P. Morgan, Chase, and Citigroup, all made $100 billion for the first time in a decade, with their staff expanding. From the first quarter of 2020 to the third quarter of this year, Morgan Stanley's workforce surged by 34%. JP Morgan Chase and the Citigroup employee grew 13% and 17% respectively. However, after 2021, as the overall revenue of Wall Street investment banking business shrinks about 40%, the largest banks have said they will continue to lay off workers, and the whole industry is at the forefront of layoffs and optimization. Some people will be fired. We're making modest layoffs worldwide for most companies. This is the case after many years of development. Following Goldman Sachs, Morgan Stanley CEO James Gorman also announced his job cuts to the media. Morgan Stanley, which employs nearly 82,000 people, has announced about 1,600 jobs, or 2% of its workforce, 2 months ago. Morgan Stanley reported a third quarter profit drop of 29% and a 12% drop in revenue. Barclays and Citibank also started layoffs, in small amounts, but equally ominous. The tide of the Fed boom in previous years is over, and everyone has to prepare for a hard time. At the end of October, JP Morgan Chase net profit fell 17% from a year earlier, while Bank of America fell 8% from a year earlier. In this case, financial institutions such as JP Morgan Chase, Bank of America, and Citigroup also considering cutting their bonuses by a third. Wall Street investment banks' incentives could fall by more than 45% overall. With the chill of investment banks, there are deep worries about the U.S. stock market. From 2020 to 2021, with the lack of fiscal and monetary policy, the U.S. stock market is super prosperous and hitting new highs. The Dow Jones Industrial Average ended the year up nearly 19%, and the Nasdaq up 21%, and the S&P 500 up 27%. By September 2021, their price-to-earnings ratio has risen to 25.9 times, 39.9 times, and 26.6 times, respectively, while their price-to-book ratios up by 6.73% times, 5.9 times, and 4.51 times. By now, such valuations are getting lonely at the top. The benchmark S&P 500 has fallen 19.8% since 2022, perhaps its biggest annual decline since 2008. It's like riding a crazy roller coaster, according to Fed Chairman Colin Powell. Not just the stock market. High inflation with high interest rates, slowing growth, and weak labor market conditions also hurt families and businesses. Powell explained to the public, "We have to keep inflation under control. I hope there is a painless way to do this, but not." Even more troubling, Wall Street generally misses hopes for the U.S. economy for the next year. The U.S. stock market will have the worst year since the global financial crisis, and the corporate profits will suffer the same fate, warned Mike Wilson, chief U.S. strategist at Morgan Stanley. An uncertain outlook for global economic growth has made investors hesitant about long-term investments. "We have to assume that we have some rough times ahead," David Solomon told the media. "We have to be more cautious about the financial resources, the size of the organization, and the footprint." What makes CEOs extremely cautious is that they still fail to see where the Russian-Ukraine conflict and China-US relations are headed in the new year. More importantly, the Fed, which has been crazy, is now raising interest rates again. Starting in March 2022, the Fed has raised interest rates 7 times in 2022, for a total of 425 basis points. Eventually, the Fed will raise its target range for the federal funds rate to between 4.25% and 4.50%, the highest level since the subprime crisis in 2008. On November 30th, Powell again said publicly that U.S. fight against inflation was far from over, and that the Fed's approach to raising interest rates will continue for some time longer. Some job market and economy may even be sacrificed to control inflation. Continued aggressive increases in interest rates have raised market expectations of a recession in the U.S., while Mr. Biden said the current slowdown was not surprising, insisting that the United States is still on the right path, and insisted that even a U.S. recession in the future will be a very slight recession. Recent signs of weaknesses in the U.S. economy under a recession warning have worried Mr. Wilson. Perhaps the only good news is that Mr. Wilson assured the public that, fortunately, there are not signs of systemic financial risk or distress in the housing market. But some business people, such as Elon Musk, are not so optimistic about the future. Tesla CEO Elon Musk has warned on several occasions that the U.S. economy will suffer a severe recession that lasts for a year or two. On November 30th, he again tweeted that the Fed is continuing to amplify the possibility of a severe recession, and the U.S. economic trends are worrying. Amazon founder Jeff Bezos, speaking to the media that the recent recession in the United States is just around the corner, even advised Americans to cut back in the coming months and not buying big items such as cars and televisions. Pessimistic attitude of entrepreneurs come from their somber observation of themselves and their peers. Just now, IBM announced it would cut 3,900 jobs, cutting its 280,000 employees by 1.4% in order to spin off its healthcare business. In 2022, U.S. tech giants have laid off more than 60,000 jobs, and many people thought it was the end, but they didn't know it was just the beginning. As soon as 2023, Amazon confirmed the launch of a new round of layoffs. The number of layoffs is expected to reach 18,000 employees, becoming the largest layoffs in Amazon history. Microsoft announced it will cut 10,000 employees by the end of March, and Google 12,000, with Twitter aims to reduce its total workforce to pre-IPO levels. Roel Rubini, who accurately predicted the 2008 financial tsunami, is even more pessimistic. He believes that the U.S. economy will not only face inflation and recession, but will face a big stagflation debt crisis, as the core fixed asset of American real estate, in fact, has been delicate, even bad. During the epidemic, the Federal Reserve continued for 2 years, launched the financial prosperity and even the bubble on Wall Street, but also make the American real estate again to the dangerous high and a risk. In 2020 and 2021, the U.S. property market has experienced a boom seen in the past 2 decades. A phrase, how much more American house rise in 2021, increased 350% times in Google's search frequency in a week. The price is almost skyrocketing. A house buyer said excitedly, basically have to rely on rob dozens of people to grab a suite is very common. Without increasing the price, cannot buy a house. In April 2021, Mr. Zhang, a Chinese resident now living in San Diego, California, told the media that a house in a good neighborhood near his house could be sold at around 10 to 15 days after hanging up. To impress the original owner, the buyers would have to pay at least 10 to 20% more for prices. Every day, there are about 30 or 40 groups of people echoing up to see a suite, and many people directly carrying cash to the scene, sometimes before they roll up. The people in front of the people directly throw money to grab orders. A total of 6.12 million properties were sold nationwide in 2021, the highest performance since 2006. During the post-2020 pandemic, house prices in the United States rose by 43% in 2 years. Meanwhile, the data shows that the housing prices in 20 U.S. cities jumped 14.9%, the highest level since November 2005. In the first half of 2021, the boom of the U.S. housing market continued. Prices rose 19.8% in February from a year earlier, the highest increase in 25 years and 4 times the average increase over the past decade. In June, the median price of the U.S. home sale peaked at $413,800. Then the Federal Reserve's violent interest rate hike pushed the U.S. property market off a cliff. At the end of October, mortgage rates in the U.S. topped 7%, the highest level in 20 years. As interest rates surged, U.S. home buyer confidence fell to 39, the lowest level since the 1980s. In December, the NAHB Home Builder Confidence Index was just 31, down from the February 2007 levels. The index below 50 represents a contraction in the housing market. Lack of confidence, so that the originally hot property market quickly entered a freezing period. Meanwhile, Cocoon chief economist John McLaughlin's bold prediction is that the good days when the working families can easily buy a quality homes anywhere in the U.S. are over. Prices have soared in the past 2 years, forcing them to buy homes for 5 to 10 years. The rising interest rates have increased repayment pressure for buyers, hitting the purchasing power. Finally, the demand for housing fell sharply, and the housing prices changed from rising to falling. In 2022, the total sales of finished houses decreased for 11 consecutive months, and in the second half of the year, the housing price also maintained the growth momentum and began to fall. KPMG chief economist Diane Swog forecasts that U.S. house prices could fall by 15% in 2023. The sudden slowdown in the once soaring housing market makes the value of stocks firmly tied to real estate extremely uncertain. Rubini believes stock value will shrink as much as 40% in 2023. After the soaring U.S. housing prices in the 2 years, many people began to wonder whether the U.S. real estate bubble again. After all, one of the keys to the 2008 financial tsunami was the real estate bubble. Now the U.S. is under a dual pressure from real estate and the stock market, raising fears that a bigger storm is brewing. Many people have forgotten that 2002, former Fed Chairman Alan Greenspan said, "Our housing boom is actually made of a massive increase in mortgage debt, and this boom is unsustainable." On the eve of the financial tsunami, U.S. house prices rose by 10% a year, up 17% in 2005, an average of more than 50% in the 4 years from 2003 to 2006. In the 5 years of 2002 to 2006, Fed raised interest rates 17 times in a row, leading to the housing loan interest rates is soaring, hiring housing pressures collapse, crazy fall. The housing market crash collapsed, the stock market falling 50%, and then unemployment soared, household consumption and business investment fell rapidly. Eventually, the U.S. economy fell to recession. This led to a financial tsunami for the world. While Fed Chairman Colin Powell is optimistic that U.S. property is stable without a repeat of the 2008 crash or recession, the prevailing view of the market is also that the rapid rise in U.S. housing market during the pandemic is different from what it was in 2008. Now, however, the large number of layoffs, the stock market boom and decline, the housing market worries again. More and more people think the story is familiar. They are worried that they keep speculating that America is suffering again. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.